In an effort to stave off another financial crisis like the one we saw more than 2 years ago, Washington is putting into place new rules on mortgages. However, according to our next guest, those rules, which are aimed at protecting the consumer, will ultimately penalize them. Here to explain is John Sauro from North Atlantic Mortgage in Stamford. Just recently traveled to Washington to meet with lawmakers about these regulations. And John, good having you back on the program.
It's good to be back, Becky.
You know, I think many people thought we had the financial crisis. Some new rules were put into place. They changed, limits on mortgages, etc., and that was it. But this is all being phased in, and we still haven't seen a lot of these regulations being put into place, have we?
No, that's correct. Dodd-Frank doesn't go into place until July 21st, and a lot of the freshman congressmen want to see it repealed or at least the language modified.
All right. When you went down to Washington. What was your beef? Where do you see as the problem?
Well, we went down to Washington because the Federal Reserve took it upon themselves to come out with a regulation regarding dictating compensation within our industry. I'm not talking about dictating compensation for the CEOs or the executives within the mortgage firms, but for the little guy, the loan originator who assists people with getting financing. And so the NAMB, which I'm on the Government Affairs Committee for, went down and we lobbied the Congress. I personally met with members of the House Financial Services Committee and discussed this rule with them and how it's going to have an effect on the consumer. And 33 congressmen and 3 senators wrote a letter to the Federal Reserve requesting that they either delay or eliminate Fed Rule 226 regarding loan originator compensation.
All right, let's talk a little bit about, it's very confusing because you have Dodd-Frank over here.
Right.
You've got the Federal Reserve over here, each with their own proposals and regulations in the mortgage market?
Well, the Federal Reserve regulation does mirror some of the language that's in Dodd-Frank, so they're very similar. Dodd-Frank's language is not as bad as the Federal Reserve's language. Okay, but they both are trying to accomplish the same thing, which is to dictate compensation models. Now, imagine this. Let's say that you're a business owner and the government can dictate to you how much you could sell a product or a service for and tell you how much you can pay your employees. Now, that's exactly what they're doing here, and they're not going to stop in the mortgage industry. We were told in a meeting with the Federal Reserve and Treasury Secretary Timothy Geithner that they intend to do this in other industries, starting next with the auto industry.
Well, it's interesting because was the goal of this, that when we got into the real estate crisis, the mortgage crisis, there was predatory lending, and some of the fault laid with the brokers who were directing potential buyers to mortgages with higher fees, because then brokers would in turn make more money. Mm-hmm. And this was to protect consumers.
And that's fine. Anti-steering is what it's called. Mm-hmm. And I agree, there should be some restrictions on steering. And the thing is that a lot of these regulations have already been in place. It's not that we didn't have regulations.
They weren't enforced.
They were not enforced. And that's why the Federal Reserve is backpedaling now, because they took quite a beating from their colleagues in the government and the public that they didn't do enough to keep this crisis from happening. And they didn't do enough because they didn't enforce enough. So now they're over-regulating and over-legislating to the point where it's going to add pressure to the real estate market.
Yeah, let's talk a little bit about what's deemed a qualified residential mortgage. This is a real bone of contention.
Yes.
What do they call it, QRM?
It's a good question because nobody really knows yet. The various government agencies now are weighing in as to what a QRM should be. If you read Dodd-Frank, it basically says that anything other than a 30-year fixed-rate mortgage is not a qualified residential mortgage. So for the few no-income check loans that are out there still, they'll be gone. They're talking about having to have a minimum, mind you, of 20% down in order to buy a home.
Now, how are banks, my understanding is that banks are reluctant now to lock in these extremely low interest rates for 30 years, so it's so hard to get a 30-year fixed-rate mortgage.
It is hard, but remember something else. The banks will lock them in as long as it's a good qualified borrower.
Good credit score,
great score.
20% down.
Right, great income, assets in the bank, and they'll do it. And you know why they'll do it? Because they're not at risk. Because the banks are not banks. The banks are brokers. just like any other broker out there. They are selling those loans to Fannie, Freddie, and FHA.
Which is interesting because that really isn't addressed in any of this. I mean, the heart of this is the security, well, part of it was the double leverage in mortgages.
Right. Mm-hmm.
And part of that is not only the risk taken on by the buyer, but then the securitization market and that risk. And that wasn't really addressed, was it?
No, it was not addressed. And Fannie and Freddie are still not being addressed. I know the congressmen that I've spoken with really want to see something done with Fannie, Freddie. And of course, in Washington, you have this back and Democrats and the Republicans, and it seems like nothing's getting done. But something has to be done because these are giant quasi-governmental agencies. And my opinion is that they should be privatized. They should get all the big banks that sold all the loans to Fannie Freddie. They should pony up. They should take shares within Fannie and Freddie, and then they should be responsible for Fannie and Freddie. So this way, when they do sell loans to Fannie and Freddie, they are also still at risk.
Yeah. Well, we're going to continue our conversation.
Okay.
John Sauro is going to stay with us, and we'll be back with more 12 on the Money after the break. And welcome back. We're currently discussing the new rules on mortgages coming out of Washington and what long-term impact they could have on the ability of potential home buyers to actually get a loan and what they're going to pay for that loan. Back with us is John Sauro from North Atlantic Mortgage in Stamford. All right, one thing that potential home buyers need to know is there's going to be a pulling back on the limits in mortgages, right?
Yes,
coming
on the jumbo limits. There's going to be a pulling back October of this year. Right now, you can get a jumbo loan through Fannie Mae, Freddie Mac, up to a loan amount of $729,000. Comes October, they're going to pull that back, and you're only going to be able to do $417,000 with Fannie and Freddie. And that's going to leave quite a gap for jumbo mortgages, because as you know, nobody's securitizing jumbo mortgages right now. And so the borrower out there is going to have a problem where when they have to get a jumbo mortgage, A, they may not be able to get one, B, if they do, it's not going to be cheap.
All right, and that is really going to have a negative impact here in Fairfield County.
Huge impact. Fairfield County, Westchester County, Manhattan, the Hamptons, you know, any jumbo area is going to have a massive impact, and we already have a fragile real estate market.
Yeah. Let's talk about something called the SAFE Act.
Yes.
What is that, and how will it impact potential home buyers?
SAFE Act was a law that came out in 2008, a Secure and Fair Mortgage Licensing Act. And basically what it says is that if you're a mortgage originator who is assisting a borrower in getting a loan, that you must be educated, you must be tested, and you must be licensed.
All makes sense.
Absolutely. I've been a big advocate for years. As a matter of fact, one of the only states in the country for many years that had a test was Florida. I took the test. It's a very difficult test. But why not be tested? If you need a Series 7 to sell stocks, you should need a license to do mortgages. So that's fine. However, the law didn't go far enough because the law stated that anyone who worked for a bank, federally or state chartered, did not need to abide by this law. So therefore, if you go to a bank for a loan, those people are not educated on the market, they're not tested, and they're not licensed.
Well, the thinking behind that was that they've had other kinds of training within because they work for the bank that would cover that?
Well, I used to work for a big bank, and I can tell you the training doesn't make a dent. There is no logic behind it. Basically, you have lobbyists in Washington that fight for the banks, and the banks became exempt. Now, if those bank employees had to take a test today, 40% of them would fail the test. So the consumer has to ask themselves, do I want to put the largest financial transaction in my life in the hands of somebody who has not been educated, tested, or licensed with these banks? And that's why you really need to stay with the small lenders, the mortgage bankers, and the mortgage brokers, because they all have been licensed. And you have to get licensed not just nationally, but for every state you want to do business in.
I want to talk to you very briefly, but I want to get it in about mortgage modifications.
Yes.
You know, this foreclosure market, the short sales, this is really hurting real estate values, and it's kind of slowing this whole process down.
Absolutely.
So where do we stand with this?
Well, the modification process is probably the biggest joke going. The Home Affordable, the Obama Home Affordable, basically said go to your bank and the banks will do a modification and lower your rate and help you out.
I think one of the biggest problems is showing a stream of income, isn't it? I mean,
well, absolutely.
If you can't pay your mortgage, chances are good it's because you've either had some kind of a medical issue or
Right.
you lost your job.
Especially, we'll look at unemployment right now. So
Right.
that's a problem. The problem with the modifications is I know very few people that have actually been able to get them. And the ironic thing about it is in order for you to be able to qualify for a modification with these banks, you have to stop making your payment for 3 months. So what if your credit isn't bad? What if you're just one of those people who are proactive and say, gee, you know what, I lost my job, I've got 6 months to a year worth of reserves that I could pay my mortgage, I'm okay for a while, but I need some help. You're going to tell me that you have to stop paying your mortgage and ruin your credit so that you can get some help. That makes absolutely no sense.
Overall, where do we stand with this? Do you see us getting out of the real slump soon?
The only time I think we'll get out of the slump in housing is if we see better numbers with unemployment. Because if you have a healthy employment market, you'll have a healthy housing market. That's part of it. But the other part of it is this over-regulation and over-legislation is only going to make matters worse. They're not doing anything to shore up this real estate market.
All right. John Sauro, always good having you on the program.
Pleasure being back.
Okay. And we'll be back with more 12 on the Money after the break.